Every publicly traded company in the world is required to publish 3 core financial documents on a regular basis: the income statement, the balance sheet, and the cash flow statement. Together, these 3 documents tell you everything about the financial health of a business: how much money it makes, what it owns and owes, and whether it actually generates real cash. Most investors never read them. They rely on headlines, analyst summaries, and social media to make decisions about companies they own or are considering buying. That is the equivalent of buying a house without looking at the inspection report. The information is there. It is public. It is free. And the investors who read it consistently have a fundamental advantage over the majority who do not. This is week 14 of The Algorithm Investor. Today we are covering how to read all 3 financial statements in plain English with no accounting degree required. Let us start with the income statement, also called the profit and loss statement, or P&L. This tells you how much money the company made or lost over a specific period, typically a quarter or a full year. The income statement flows from top to bottom. Revenue at the top. Various expenses subtracted in layers. Net income at the bottom. Revenue is called the top line. Net income is called the bottom line. Revenue, also called sales, is the total money the company received from selling its products or services. This is the starting point for everything that follows. Cost of goods sold is the direct cost of producing whatever the company sold. Revenue minus cost of goods sold gives you gross profit. Gross profit margin, gross profit divided by revenue, is one of the most important metrics for understanding a business. Software companies often have gross margins above 70%. Grocery retailers around 25%. The margin tells you the fundamental economics of the business before anything else. Below gross profit comes operating expenses, the costs of running the business beyond direct production. Sales, marketing, research, general and administrative costs. Subtract these from gross profit, and you get operating income. Operating margin, operating income divided by revenue, tells you how efficiently the company converts revenue into profit from core operations. A rising operating margin over time signals improving efficiency or growing pricing power. Below operating income comes interest expense on debt, then taxes, and finally net income, the bottom line. What the company earned for its shareholders after every expense is paid. Earnings per share, net income divided by shares outstanding, is derived from net income and is the number most widely reported in financial news. It is the foundation of the P/E ratio we covered in week 11. Now the balance sheet. Where the income statement shows performance over a period of time, the balance sheet is a snapshot, a photograph of the company's financial position at one specific point in time. The balance sheet has 2 sides that must always balance. Assets on one side, liabilities plus shareholders' equity on the other. Assets always equal liabilities plus equity. This is the fundamental accounting equation and it never breaks. Assets are everything the company owns or is owed. Current assets, cash, accounts receivable, inventory, can be converted to cash within 1 year. Non-current assets, property, equipment, intangible assets, are longer-term holdings. Cash is the most liquid asset. A large cash position gives a company financial flexibility to invest in growth, weather downturns, return capital to shareholders, or make acquisitions without needing to borrow. Accounts receivable is money customers owe the company for goods or services already delivered. Rising accounts receivable relative to revenue can be a warning sign. Customers may be struggling to pay, or the company may be booking revenue before it is actually collected. Liabilities are everything the company owes. Current liabilities, accounts payable, short-term debt, are due within 1 year. Long-term liabilities include bonds and mortgages maturing beyond 1 year. The debt-to-equity ratio, total liabilities divided by shareholders' equity, measures how leveraged the company is. High leverage amplifies both gains and losses and increases financial risk, particularly during economic downturns or rising interest rate environments. Shareholders' equity, also called book value, is what remains after subtracting all liabilities from all assets. It represents the theoretical value that would be returned to shareholders if all assets were sold and all debts paid. Now the cash flow statement. This is the document that experienced investors often consider the most important of the three, because it is the hardest to manipulate and shows actual cash movements of the business. The cash flow statement has three sections: operating cash flow, investing cash flow, and financing cash flow. Operating cash flow shows the cash generated by the company's core business operations. A company reporting strong net income but weak or negative operating cash flow is a serious red flag. The profits may not be translating into real cash. The difference between net income and operating cash flow is largely explained by non-cash items. Depreciation and amortization are added back because they reduce net income but involve no actual cash outflow. Investing cash flow shows cash spent on or received from long-term asset investments. Capital expenditures, money spent on property, plant, and equipment, are typically the largest investing cash outflow. Free cash flow, operating cash flow minus capital expenditures, is the cash the business generates after maintaining and growing its operations. This is arguably the most important single financial metric for evaluating a business and the foundation of the price-to-free cash flow ratio we covered in Week 11. Financing cash flow shows cash movements related to debt and equity. Issuing debt or shares raises cash. Paying dividends, repurchasing shares, or repaying debt uses cash. Share buybacks, when a company repurchases its own shares, reduce the share count, increasing earnings per share even if total earnings stay flat. Management teams that buy back shares when the stock is genuinely undervalued create significant value. Management teams that buy back shares at inflated prices destroy value. Now let us talk about how to use all three statements together to form a complete picture of any business. Step 1. Read the income statement first. Is revenue growing? Are gross margins expanding or contracting? Is operating margin rising or falling? Are expenses growing faster or slower than revenue? Step 2. Check the balance sheet for financial strength. How much cash does the company hold? What is the debt load relative to operating income? Can the company service its debt comfortably? A company with more cash than debt and strong operating income has significant financial flexibility. Step 3. Reconcile the income statement with the cash flow statement. Does strong net income translate into strong operating cash flow? Is free cash flow growing alongside revenue? A business growing revenue and net income while also growing free cash flow is a genuinely high-quality business. Step 4. Look at trends across multiple periods. One quarter in isolation means almost nothing. 4 to 8 consecutive quarters reveal the real trajectory: accelerating growth, decelerating growth, expanding margins, or deteriorating quality. Where do you find these statements for free? 3 places: the company's investor relations website, under financial results, or SEC filings; the SEC EDGAR database at sec.gov, and financial data aggregators like Macro Trends or simply WallSaint, which present the data in cleaner visual formats. Reading financial statements is a skill that compounds over time. The first time you read one, it will feel overwhelming. The 10th time, it will feel familiar. The 50th time, you will know exactly where to look and what the numbers are telling you within minutes. The investors who develop this skill consistently and apply it to the companies they own are doing something the vast majority of retail investors never do. They are reading the actual evidence rather than relying on summaries written by people who may have very different interests from their own. Next week on The Algorithm Investor, Week 15, we are covering sector investing, what sectors are, how they rotate through economic cycles, and how investors use sector ETFs to position portfolios for different economic environments. For the full breakdown on everything you need to build real wealth, subscribe to The Algorithm Investor. New video every single week. Drop a comment below. Have you ever read a company's financial statements before? Yes, no, or tried but got confused? I read every single one. See you next week.